Happy Friday, Brian Manning here with the weekly update. Let's get right to it. So Monday this week we got new home sales. This is for the month of January. New home sales, signed contracts was up 1.5%. So good to see some continual strength in new home sales there. We also got some feedback on inventory. So if we look at new home sales, and this is really for builders across the country, and we're looking at inventory, we're always just focused on completed inventory. Because if you look at inventory of a home that's available, in a year or 2 years from now, I don't really consider that as, valid current inventory. So if we look at current inventory, actual inventory supplies went from 1.46 months down to 1.45. So not a lot of inventory available as far as new home sales are concerned. Tuesday this week, we got Case-Shiller. They give us feedback on housing appreciation across the country. For the month of December, housing appreciation was up 0.2% on a month-over-month basis. This is now up 5.6% on a year-over-year basis. We also get feedback from FHFA once a month. FHFA looks at transactions that took place, purchase transactions across the country, and is only measuring transactions with conventional mortgages attached to them. So FHFA showed appreciation up 0.1% on a month-over-month basis and 6.6% year over year. So still continuing to see strong housing data. Everyone that poo-pooed the housing market and said, oh, we're going to see a housing crash, don't buy a house, you should still be renting, this is a horrible time to buy a house. On average across the country in the last 5 years, homes have gone up 46%. So everyone that poo-pooed the housing market, here we are still seeing solid housing. We're still seeing decent appreciation across the board, which is really great to see. Also, we got durable goods feedback. So this gives us information on durable goods orders. So durable goods are large ticket items that you would buy that have a 3-year or longer life expectancy to them. So this is something that's looked at so we can start gauging or continue to gauge inflation. Durable goods orders were down 6.1% on a month-over-month basis. This was expected to be down about 4.5%. So, when you have less big ticket items being sold and you have such a significant drop, more than expected, it would just show you that inflation should still start getting tamed or continue to be tamed. We're going to talk about that more in a minute. Thursday this week, we get PCE. So PCE stands for Personal Consumption Expenditure. It's the Federal Reserve's favorite gauge of inflation. This is for the month of January. PCE on a month-over-month basis was up 0.3%. So this was kind of in line and as expected on a year-over-year basis. This went from 2.6% down to 2.4. So not a huge drop in inflationary pressure there, but a little bit of a move. If we look at the core rate, this is really what the Federal Reserve looks like. The core rate takes out volatile items such as food and energy. Core rate was up 0.4% on a month-over-month basis, and this moved from 2.9% down to 2.8%. So, this is really in line with expectations, but was not as big of a move in inflation as we were hoping for. So, today we don't really have a lot to talk about for news. So really, what I really wanted to do was just look at more inflation information, really try and get our finger on the pulse of what's going to happen. So the Federal Reserve is watching inflation data. They're trying to make a decision on when they should cut interest rates, and they want to see their target of that core PCE rate at 2% as they're getting ready to cut rates. But what's interesting is this month we've had mortgage rates increase. It has not been a great month for mortgage rates. And the primary reason is because we've seen hotter than expected inflation data. But some of it doesn't really make much sense. And I'm not a conspiracy theorist. I don't try and come up with these crackpot ideas. I always just like to look at the facts and the data. So if we look at CPI, this is a second gauge of inflation. Also in PCE, what's the biggest driving factor in these inflation numbers right now is what's called owner's equivalent of rent. So owner's equivalent of rent is when someone with a single family residence across the country gets contacted, and the question that they're asked is, if someone were to rent your home today, how much do you think it would rent for monthly, unfurnished and without utilities? Well, most people don't know. I don't know the answer. And so if you call me one month, I might tell you a number. You call me another month, I'll tell you a different number. And a third of the CPI inflation number is based off this question right here, which is crazy. Now, if you were calling, let's just say firms that run multifamily properties or apartment buildings, they're likely going to better have their finger on the pulse of what's happening with rents, and this is going to be more impactful as far as shelter costs are concerned. But when you're just calling normal people and asking them how much they think their home will rent for, and that's 1/3 of the CPI inflation number and 1/6 of PCE, of course we're not seeing these numbers meaningfully move around or lower, because it just doesn't make any sense to me. So what's insane is if we look at Owner's equivalent of rent. So this drove inflation this month. We had inflation numbers not come down as much as we were hoping for. We had mortgage rates move up a little bit this month because inflation numbers weren't really where we wanted them to be. If you look at this spike in owner's equivalent of rent. So this did not have positive impact on inflation numbers, and that's why we saw some changes in mortgage rates this month. But if you look at actual rents that are out there in the marketplace, you see true rents coming down, but owner's equivalent of rent is going up. Also, if we look at vacancies, vacancy rates right now are at 6.6%. So if you're just calling people and asking them how much their home is going to rent for, compared to actually getting true factual information on the numbers, and that's a third of your data, it just doesn't make any sense to me. So vacancies are up 6.6%. So this would lead you to believe that you would see rents coming down because we're now back to pre-pandemic levels of vacancies. And then if we look at rents, this is new rents right now. Actually, new rents based on apartment lists are actually negative right now. So if you were going to go rent an apartment, new rents are going up at a negative rate right now. So if we look at what's happening with interest rates this month, you had rates, move higher this month. You had inflation reports come out that were not as favorable as we're hoping for. But you look at the main contributing factors to this inflation report that we're getting, or these reports that we're getting, it just doesn't make sense. So we'll have to keep an eye on this. Hopefully we get better inflation reports going into next month. But that's where we're at for right now, and that's why you see movement in the mortgage markets this week, and this month, and as far as why you see mortgage rates move a little bit higher this month. I'm around all weekend. If you have any questions, let me know. If you want to learn how we're closing purchase transactions in 10 to 14 days start to finish, give me a call. Happy Friday. Have a great day.